Okay. Okay. Well, welcome everyone. Thank you for joining. I'm Kate Wentrobel. I am a neighbor, new neighbor. We opened this location September 2021. So we're right on Smallman across from the terminal. I will tell you a little bit about my background, and I'll give Chuck an opportunity too before we, dive into the presentation. I've been in banking for 15 years. Yesterday, Chuck wished me happy 50th birthday, but not that many years, or not capable of that many years yet. But I have been in banking for 15, and I've been with Huntington for 5 of those. I chose Huntington for my career because honestly, their corporate initiatives and corporate moral compass just really align with my personal values. And so it's a really good fit for me. I kind of grew up through the bank, through the banker, teller, banker, manager. And I'm currently the branch manager at the local strip district, which is how I know Jen and Cancer Bridges as neighbors. But thank you for joining. And then Chuck, if you want to introduce yourself.
Yes, good afternoon, everybody. My name is Chuck Spacuzza. I'm a branch manager over in Glassport area, over outside of the South Hills. I've been working with banks and at Huntington Bank for 12 years, but been in banking for 22 now. Most of it is time as a manager throughout the 2 different careers. I think I came to Huntington Bank, and once I came to Huntington Bank, the thing that has stuck the most is items like this. Huntington Bank is very, very empowering when it comes to us taking care of our community and doing stuff to help people and help our community and help our neighbors. So I'm excited about this. This is our first one for Cancer Bridges, as Kate said, and Jen said, and we look to be doing at least 3 of these. And then we also will have ability to speak to people one-off on their current situations. And there will be, if you're able to view chat, I will, if you have questions throughout, you're welcome. If you don't want to get on a microphone, you can put questions throughout. And then when we do have our little breaks or pauses in any of the presentations, I will address Kate for your questions for you. And I also will have our direct emails and our phone numbers. So after these calls or at a different time, you could always reach out to Kate or I.
Perfect. Thanks, Chuck. Yeah, so you'll see on our first slide here, this is called the Managing Debt. We just worked with Jen around what topics might matter to the participants. So this slide, while it's Huntington colleagues bringing this to you, it's actually FDIC Money Smart Guide is what it's called. So it's FDIC content that we're providing. We did trim it down. I'll call out some of the big sections that we really cut out, but we want to, you can only do a Teams meeting for so long. So, we were trying to live in a 45-minute window. There are 42 slides and we've got 45 minutes. So I will tell you, I talk a little quickly in some sections that I think we could probably go high level. But if you want to double click on anything, you're welcome to ask a question and I can back it up. I do pause for questions after every section, just to give an opportunity over to you guys to, before we continue too far, make sure that you and I are all on the same page. So we'll go ahead and just dive right in. So the first part of our time today is really just understanding some basics around how debt is established. And it really starts with understanding in sum what all your debt really is. And so the difference between credit and debit feels like a good spot for us to start. So debt, right, is just money you owe. And then credit is the ability to borrow money. Credit can generally be really that sort of access to money, whether that's all in mortgage right up front or access to money on something like a credit card. And then of course you've got your debtor and your creditor. What's the difference? Well, it's really you and then the bank usually. So we're the debtor, right? Because we owe the money, and then the creditor is the person who, or the company that lends the money. In some cases, it's a person. In other cases, it's a company or a bank. And then of course, we want to talk a little bit about understanding your debt. And there's some basics that I think probably we all know, right? You want to know what you owe, how much you owe, what your payments are, when you owe that money and when it's due. But this last bullet, other important facts about your debt, we really dive into that a little bit in this presentation. And that's going to include things like your interest rate. And when you're managing debt, interest rate is a key per debt. We want to know the individualized interest rate. You also want to know the term and how long you have left on the term. So what I'm referencing there would be a mortgage. That's generally most mortgages are 30 years. And if you've had your home for 10 years, you've got 20 years left. Or a car loan for 5 years with 3 years left. That indicates to us or the person giving you banking advice where you're at in your amortization schedule. And your amortization schedule basically is when your interest is assessed and how much. It's usually front loaded, meaning at the beginning of a new debt or beginning of your mortgage, beginning of your car loan, more of your payment goes to interest than towards the end of your payments. And so we use that to determine, what's the best or right debt to pay off. And then even things like, think of a 0% card, right? You want to make sure you're not getting any additional fees or things like that. So credit card debt when you're moving it to those 0% offers. So a lot can go into understanding your debt, sometimes more than we think. People get into debt for many reasons. Obviously, purchasing assets, car, home, even boats, right? That would be ideal and fantastic. Love that. Paying bills, right? And that can be the result even of not paying a bill. So maybe we're thinking, oh, I'm just going to pause on that electricity bill for the month. Next thing you know, now it's $250, $400, and it gets bigger and harder. Medical bills, which may be the cause of you being on the phone today, covering unexpected expenses or emergencies, and buying something that we want or something that we need, right? So I've got 2 under 2, and so that means formula and diapers all day for me and my family. All right, so how debt can affect your financial situation. A couple of things. I think some of this seems rather basic, but I want to try to bring it to life. So needing to use future income to pay your debts. Well, think about tax time. Have you ever been someone that come Christmas, you see something on the shelf or something you would love to be able to gift to somebody, or possibly gift to yourself? We deserve things too. And you think, oh, it's okay because I'll use my income tax for that. I know I'm going to get money back, right? So you're utilizing future income to pay something that is in front of you right now. Well, the problem with that is that generally you're going to either pay interest on those funds, right? And then create a little bit of additional debt where debt might not have existed. And then it can impact how soon you can pay things, right? So a $100 sweater shirt that you let ride on a credit card is $120 a few months later, right? Or not quite down as low as we want to. So that's just a couple of different examples. And I do consider this an annoying cycle for folks, but it's a cycle that sometimes we have to live in. So I'll pause here for questions on anything I covered thus far. Feel free to put it in the chat. I don't know, Chuck, if we've got anything thus far. We're feeling pretty good to carry on.
I have nothing in the chat. If anybody wants to come off mute, if they do have any type of questions or general questions just about the basics part of the debt, please feel free to either chat it or come off mute.
Perfect. When I timed myself, I was 25 minutes and I didn't include time for questions. So I feel really good about the process. All right. So next section that we have is really just considering how debt works so that you can make informed decisions about the debt that you have. And so there's, going backwards. So there's really 2 types of debt. And the first type is an installment loan. And I feel like this is something most of us would be really familiar with, right? So that's an amount of money that you borrow over a specific amount of time. And then you're generally paying the same amount every single month. You don't typically see variable rate interest on this or even a variable rate payment. It's usually, I borrowed, $5,000 at $150 over 5 years until that 5 years is up. That's what I pay. This is your, I'm going to go with your most basic form of debt. And then you've got revolving credit. Revolving credit is anything that has where you have access to additional funds. So most commonly that would be a credit card. You can spend up to $5,000, but you only owe on whatever you've borrowed. So say $1,000. So your payment is based on what you've used, and generally they use a rule of thumb around 1 to 5% of your outstanding balance on credit cards. That's the most common. These products typically have a higher interest rate because the risk is greater to the bank, right? So if you have continued use and open availability to money, the risk goes up, right? Because you could borrow up to 20,000 or up to 5,000, and we don't know when you borrow that 5 or 20. Did your financial situation change than it once was when you originally applied for it? Versus something like a term, right? The previous slide, where we have a very clear picture of what you can afford, your payment would not change, comfort is greater, therefore risk is lower, and when risk is lower, rate is associated with that safety to the bank. So with revolving credit, the key is pay more, pay often, pay sooner, and then you pay less interest. One of the things we also wanted to mention on this slide, very 2023, have you ever seen on your credit card statement, or even Amazon might offer Easy Pay? Easy Pay is getting people into a little bit of little predicaments because it's making you think, right, oh, I'll just finance this $300 for $30 over, 9 months, right, or 10 months. Well, those little payments that you can't afford, they add up, and they're creating a little bit of additional stress or even anxiety, right? Some big ticket words when it comes to managing debt. So that's another one we wanted to call out just to be a little relevant to what we are seeing now. But the primary forms are revolving credit and term. Next, we've got, obviously there's fees, right? So fees to either take on the debt, that's common. But a lot of people think it's just interest, and that's not the case. There can be annual fees. A lot of credit cards that have really good rewards programs have an annual fee associated with those cards. Balance transfer, so taking a balance from one credit card and moving it to another, there's usually a fee associated with that. Late fees is a common one. So there can be fees for a lot of different things. We want to make sure you understand what those fees might be. And then prepayment. There can be fees for prepayment penalties. I would say on the personal side, this is less common. There's some specific products that build in a prepayment fee, and it's usually on a situation where the bank is maybe offering the customer something really great, right? And we would want to make sure that we host that loan for a long time.
One of the biggest things that I see prepayment on for most customers is newer mortgages. Depending on the mortgage program that some customers used, they cannot refinance their loan for 3 years or 5 years without having a large fee. So they may have done a 30-year mortgage, and it's been 3 years and they can see rates have went down, but they may have a 3-year or 5-year prepayment for them to refinance and go into something different. So always check in the future as you're getting something, check to make sure that there isn't a prepayment. But before you are refinancing any debt, you do want to make sure that there is no prepayment penalties, or if there are, that it still makes sense for you to refinance debt if you're saving enough money.
Yep, exactly. That's perfect. Thanks, Chuck. So that's really understanding how debt works, some of that ins and outs. Any questions in the chat thus far? All good?
No questions yet.
All right, so section 3. So this is all around developing a plan to reduce your debt. We also mention in here that you can always reach out for help. Help can be a trained credit counselor, which Chuck nor myself are. We don't have any certifications or anything like that. It's really us speaking to you from the years in the banking industry, personal situations, our client situations, right? And just sort of using all of those experiences to create, our own opinions and coupling that with the FDIC deck that we have here today. The other thing I want to say before we dive in is we're going to talk a little bit about two different strategies and how they operate, but there's no one size fits all. So the key thing is for you, as we move through, if you're really thinking you have personal debt that you want to tackle, these are two choices. I personally like one more than the other, but it's what will work for you. And we're going to talk about that. But I just want you to have that lens on of it's not one size fits all. It's all about your situation and really thinking what might work for you. So two strategies for reducing debt: high cost debt first and the snowball method. And so we're going to dive in first to the high cost debt method. All right, so there's a big advantage to this one is it saves the most money. So this is going to be the one where if you said my end all be all is to get rid of this debt as quickly as possible, right, and save the most money, give the least amount of money to the bank, this would be the right method. The problem is the progress feels, and that's the key word, it feels slower. So you're going to, in this situation, you would list your debts highest cost to you to the lowest cost to you. You might be asking, what does cost to you mean? Cost to you specifically is the interest rate that you are charged from the bank associated with that debt. So in this example, if we have a credit card that you owe $15,000 on, and the cost to you and the interest rate with that $15,000 is, let's go with 20%, which actually wouldn't be a terrible credit card debt rate, but let's go with 20 for the scenario. You would put that $15,000 debt at the top of your list. And then your second debt might only be for $5,000 and the interest rate is 19%. So the method that you would do in this circumstance is you would pay the amount on all your debts. You would take any extra money you have to that first debt that you owed 20% interest rate. And after you pay that off, which will take you longer, because in this scenario, it's 15,000. Remember, we said it's 15,000 at 20%. So it's going to take you a long time to pay 15% off. So there's going to be an amount of time where you don't have that win, right? When we say progress may feel slower, you're not going to feel like you've accomplished much in this high cost debt first method. So you're going to take that payment to the first debt on the list. And then as you pay that off, you're going to take that minimum payment you were originally sending to that 15, and you're going to send it to item number 2. And you're going to keep adding your payments up, but you're always sending money to the highest interest, any extra money to the highest interest rate product. That is the high cost debt first method. Next is the snowball method. Now the advantage is you feel like you're making progress faster, and I'll talk about why. But the disadvantage is it technically, right, you might pay a little bit more money to the bank. So in this scenario, you're going to list your lowest balance debt. So that 20,000 where you were getting charged or that 15,000 where you were getting charged 20%, that's not going to make the top of this list. That's probably going to make the bottom of that list. So you're going to list your lowest balance. That might be a small credit, maybe a $200 auto payment, car payment. Maybe your interest rate is 7%, but it's $200 and you only have X amount left. You're going to pay that. And then when that's paid in full, you're going to shift it to the next bucket. I will make a note. The snowball method is ideal with strictly playing in the revolving credit space, just because payments can adjust. Remember with revolving credit, you're working 1 to 5%. So think of a credit card and all you owe is $500. Your minimum payment's probably $30. So you're going to take that $30, pay off, let's say your TJ Maxx card, because I love TJ Maxx. Then you pay off that TJ Maxx card that you only owed $500. You put all your extra money there, and then you're going to shift it to the next card. But when you get to shift, you emotionally feel like you you were successful. TJ Maxx is paid in full. Now you can take the $30 minimum that you owed TJ Maxx, whatever extra you happen to be sending to TJ Maxx, and you can shift it to that second line item that you've created. And this is the snowball method. And I would say this is emotionally motivating. I very much relate this to weight loss. Like, you just want to see your scale tick down. You just want to lose 1 pound, and it keeps you going. If you're able to see that you've lost a little bit, it keeps you motivated to not eat the cupcakes. But if you don't see it and you feel stuck, you lose motivation. So
identified that one, huh?
you just want to bear in mind which one might work for you. Here's some resources to get help. And I'm going to also say, Chuck and I are here for help. Happy to have conversations around what we've seen since being in the finance industry for all of the time that we've been in. But there are really great resources. There's nonprofit credit counseling organizations. There's a website on here that all you have to do is search credit counseling, and there's usa.gov. And then there's a lot of other resources. Sometimes people will choose, when they're really sort of at the end of their rope, right, to go towards a debt settlement company or a debt consolidation loan. My number one rule is please work with a banker if you're going down this path. I don't have, and Chuck, you can speak up here as well, I don't have a lot of great stories to tell about these companies. Their goal is to just pay the companies off that you owe. They're not considering the future impact, meaning to your credit or anything else. Their goal is just to pay it off. And when you have a very linear goal like that, there's other downfalls. And so I've worked with a lot of folks that have gone this way and then regretted it. So I would just encourage you, if you decide you think you need a debt settlement company, you think you need to go this route, have a banker in on that conversation to make sure we're asking the right questions, like long-term impact to your credit, fees associated with it. Are we going to close every card that we pay off? What do you do in case of an emergency if in fact you're removing every credit card that you would have? So we would just want to have someone with you for that. So there's that little explanation point there to proceed with caution. Chuck, anything that I might have missed on that one?
Yeah, what happens with a lot of these debt settlement companies, because their goal is to pay off for you or to help you get things paid off, is they will contact creditors and they will get stuff paid, or it'll say account settled. Say you've been behind on some of these things, they'll get it to where it says account settled. When it does that, it actually hurts you in the long run. Yes, you got it settled now, and you got that maybe the collections to stop calling you, but at the cost that it may take you anywhere from 1 to 4 years, sometimes longer, to be able to rebuild that credit onto your system, because it put as settled or accounts instead of actually showing that it was satisfied or paid off. And one of the other things that we've been seeing is there are so many of these companies that charge you a fee and do this stuff. You actually do not get a chance to get everything done the way you wanted. It may be just that you can't afford all your payments per month. And if that's the case, sit down. I can only speak for Huntington because we're at Huntington on this, and I haven't dealt with the other banks with it. We have programs that we sit down with customers, whether you're doing something with us or not. We put in your debt. We give you an idea of how to eliminate the stuff. We have little debt schedules that we can work on with customers. And when she was talking about the highest cost or the snowball effect and all those type of things, sometimes your main goal is to get rid of the $500 a month payment. And you don't care about a bunch of $40 and $50 a month payments. That $500 a month is hurting you. So sometimes we have to shift strategies, but always paying stuff off with these debt settlement companies might give you short-term gain, but it's going to probably give you long-term pain. So definitely work with a banker or work with a trusted financial professional with you if you have somebody that does your financial planning. I do have a comment or question in here. It says, if you use the high cost method and start with the highest percentage, but then it becomes a lower monthly payment than other debt with a higher total debt, should you continue to pay more on the higher percentage debt? When you're using the high cost, if that's the method you want to go, is saving you the most money, then you keep paying on that until that high cost is gone totally. Because that your goal there is to save the most money, which means save the most interest. Now, if you got it down to a much lower payment after paying down that high cost and you wanted to focus on something else that had a higher payment, you could definitely shift strategies, but then you're not following that type of strategy of paying just because the cost of it for the interest rate was the highest.
Well, that's what I would have said too. So your goal, right, high cost is, and that's entering into your decision. Okay, so your goal can change, and it might change. So your goal entering into how you're going to choose to manage your debt might say, we're in a situation where we're going to choose this high cost debt first method. And then that payment goes down, and then something happens. Let's say a medical bill comes that you know, and there's a whole section on medical bills. But let's say that happens, you may need to shift a little bit of that money, and you can do that. But the goal is that any additional money, any extra money every month goes to the high cost debt first. And then after that, once paid in full, you shift it to the next debt. Again, focused on revolving credit. Term loans have better terms and conditions about them, so we normally pull those ones out. Any other questions? I don't think so, right? Awesome. So we're going to get into section 4, which is really around the non-payment of debts and debts in collection, which I think some of this does seem obvious, but I think it's an important thing to touch on because sometimes there's always high ticket words associated with debt, right? Many people can't sleep at night when they've got this lingering debt, or they're wondering how they're going to make a payment. And that's emotional, right? That's anxiety, that's stress, that's important things that we're talking about, right? I think financial situations are the number 3 cause for divorce. And so with what Chuck and I do, we know this is very important work. And so the next section is really about almost validating, right, how we might have gotten into this situation. So the life cycle of debt, current state, ideal state, take on debt, pay it on time, pay it as agreed, pay it off, right? That's best case scenario. If you have debt that's not current, you've taken on debt, you've missed a payment, which eventually could lead to delinquency. I will pause here and say, if you are communicating with your debtor, you have a better chance of that not necessarily being delinquent. Then you'll yield over time, right? You'll have a default on the loan, then it gets charged off, and then it gets sold to a collections agency. Once it's sold to a collections agency, it's just a terrible cycle because it gets usually sold and sold and sold. It's just can be even more challenging, I think, for people to tackle it. Several things can happen if you don't pay your debt. Late fees, I'm sure we've seen those, right? More money and interest over time, interest upon the interest that you're getting charged. You can get contacted from your debt collector, losing services or paying costs to reestablish services. So now being behind in your bills is costing you more money just to turn the electric back on or turn your Comcast back on. And then even more so, or even worse, right, losing collateral. So this would be a car payment, we got behind, and then the car was taken back or impounded. So what else can happen? First and foremost, negative entries on your credit reports. The more you communicate and the more you work with a banker and the longer you protect your credit, the more options you have as solutions. You almost want to envision a library with every book pushed out to the edge of your bookcase. But when your credit starts to go down and get below, I'm going to say, get below a 670, you got some challenges, still options. There's still a couple books we can see. Get below a 620, it gets less and less. Once you go below a 580, there's very few, if any, options on your bookcase within your financial institution. And that's always the best method. Within your financial institution, within a bank, those are the most cost-effective ways to borrow money. Lawsuits and creditors, obviously, wage garnishment, depending on the type of debt, account garnishment, depending on the type of debt, and then treasury offset, depending on the type of debt. So one of the things that Chuck and I did do in preparation for our time today was just look up healthcare providers. And I feel for any of you that have medical debt on the line, just because the research that we did shows a lot of inconsistencies, a lot of updates to things. It's hard to know, really what's the most relevant or the most important right now. So I'm going to read one of the things we found. It says most healthcare providers do not report to the 3 nationwide credit bureaus, which would be Equifax, Experian, and TransUnion. Most medical debts billed directly by physicians, hospitals, or other healthcare providers is not typically included. See that word? See how they make it general there? Not typically included on credit reports, and it does not generally factor within your credit report, or your credit score rather. Medical providers typically don't report to credit bureaus, but they might turn an unpaid medical debt over to a collection agency, and then that could affect your credit score. So as of July 1st, this was the most recent we could find. So as of July 1st, paid medical collection debt won't appear on consumer credit reports. In the past, if you had a debt to a medical debt and then you paid it in full, it could actually stay on your credit report up to 7 years. They removed that. Once you have medical debt that does appear on your credit report and you paid in full, it's removed. Another thing that they, this is as of this year, January 2023, your Vantage score. Vantage score models no longer considered medical debt in your credit score calculation. So they completely remove it. Medical collection debt under $500 won't be included on credit reports at all. And while some medical debts may no longer appear on credit reports, individuals remain responsible, obviously, for paying the debts. All right, a couple of key things. And a lot of what we'll share here is, again, on personal things that we've observed our customers go through or people we know go through. And it's sometimes a little crazy out there in the medical space. So before making a plan to pay a debt, you want to make sure you owe the debt. You want to make sure the statute of limitations is not expired, and you want to make sure you're dealing with, of course, legitimate debt from the collector. If payment is full, if paying in full is not possible, you want to set up a payment plan, and you want to do that as early as possible. If the person you owe and the company you owe feels like you're trying to pay them, they have a lot of leeway on sending you to collections, or they'll say, oh, don't send them. They call every month, or they're doing their best, or we know they're going to pay it back. And then you can also negotiate a lower balance. There's a note here, and you'll see that Chuck referenced this. You want to ask for it to be paid in full, not settled. Debt collectors have to follow rules. Basically, they have to be nice. They cannot be abusive, unfair, deceptive. They've got to, if you tell them that you do not want this phone call at work, then they can't call you at work. No threats of violence, no profanity. And if you have any issues, you should be reporting that. And I'm going to continue on here just for sake of time, because I see we're right at 12:38. And you're going to see we're jumping into section 6, and may note that we were actually on section 4. Section 5 was about student loans. I do have some experience in student lending from the previous institution I worked for. So I am really familiar with student lending. And if you guys have questions around student lending, happy to take those. But we just thought, for the sake of conversation, that might not apply to everybody. All right, so if you receive a medical bill, make sure it's valid. If you can't afford to pay it, try to set up a payment plan. But this whole section 6, is all around medical debt. Medical debt is basically just the result of not paying medical bills when they're due. You don't start out with a medical bill as actual debt. It's only after it goes unpaid that it becomes medical debt. Why do medical bills often turn into medical debt? Well, that's because it's not planned. And there's a bit of a snowball effect with medical debt. One, you don't know the cost usually up front. It doesn't always matter what the cost is, right? Expenses can quickly add up and it can be confusing. You don't necessarily understand every in and out of a medical bill that you get. So you also don't know the right questions to even ask. And the other thing to note here, and this isn't on the slide, but there are obviously some medical things that come our way in life that put work on pause. And if work is on pause, then income is on pause. And if income's on pause, paying things becomes difficult. So again, it's just that cycle, right? Possible actions I have in capitals, work on immediately. So make sure it's a bill and you actually owe it. If you do not owe it, you do want to dispute the bill. And if you do owe it, but you can't pay it in full, you want to negotiate a lower payment amount and you want to try to set up a payment plan. And again, you want to do that immediately. Try to settle the debt right for a price that they might think is fair or reasonable. They won't just offer that to you. You do have to ask, like, is there a way to lower this amount at all? Is there any other offering? And then get in a payment plan cycle with them. You can work with nonprofit credit counselings. And then there is a note in here that you can consider bankruptcy as a last resort. But this really should be that you've exhausted all options.
Something to think about for bankruptcy portions of this. And the only reason I bring this up is because it can affect you and you would not know. If you co-sign for anybody else, for a car, for their house, if you're a second signer on a credit card, and they filed for bankruptcy, then those creditors are allowed to go after you. So just remember, on anything that you have that has husband and wife, a child and a parent, any of that type of stuff, that's all debt that you have to consider, that if something were to happen, it may come back to you also, or vice versa. If your child's on your stuff and you had to file for bankruptcy, legitimately they can go after your child for those debts. So make sure that any debts that you're tying in with additional names, that you are sure that you have no other options, because it will affect everybody that has touched any of that portion of credit.
Thank you, Chuck. And then this is just unpaid medical debts can, and I did underline that, right? Because that's just a lack of clarity for many of you, right? It's not will, it's can. And I really want to call that out, because I think the key thing is communication from you as the person, or in this scenario, right? You as the person that would owe, right? So it's just about negotiating, communicating, and that's when I think when the company feels like there's no communication, we're never going to get this money, then they sort of flag it, and that's when it can appear. All right, debts can still be referred to collections. Medical debt in collections is not included on credit report after it's paid, which we touched on. And then Chuck, if you don't mind, in our notes section, I think you just did it. That's perfect. I just wanted to make sure you guys were referencing some of the information, and I just sent the article that we read and used. Chuck included it in the chat for you guys. And I also wanted to give a testimonial on negotiating. When I had my first daughter, Brooklyn, she's 2. I got a bill in the mail that was not covered by insurance, and it was for just under $11,000. And I thought my husband was gonna like pass out. We didn't know we were getting a bill like that, and as you can imagine, it's just stressful. So I called my doctor's office and I said, I don't know what this would be for, and she told me the test that it was for, and that my insurance just didn't cover that. So I said, well, I didn't know. No one said to me, you're about to do this $10,000 test. Do you want it? Right? So it feels unnerving at times. And she just told me to call this number, a certain person, and to ask them what the cost of this service would have been if I can pay with cash or check, and it wasn't covered by insurance. And in this scenario, I wrote a check out for $350. So I don't understand how that works, honestly, but that's just one example of why it's important to ask and to get more information. Sometimes it can save thousands, maybe sometimes it's hundreds. but I can tell you it's worth asking. And we've only got a couple more slides and then we'll go to Q&A.
I just had a medical bill that we called because it was due, and it was a little different. They said, you know what? We never processed this through your secondary insurance. Don't pay it. We're going to process it, and let's see if they pay it before you have to send us any money. So it is definitely valuable to sit and call before you do it.
Yeah. Unfortunately, that takes time, and time is not always on our side, right? Especially if we might not have the energy going through a medical situation. And then our last section is just understanding high cost debt, which is truly one slide. It's really just really high cost debt, simply put, is a payday loan or a pay advance loan from, I'm sure you've seen those like check advance places. You want to avoid those as much as possible. They're charging double digits at the end of the day, and it becomes a cycle for people. We have, this is one of those, remember I said at the beginning of our conversation, Huntington just does things differently, and their moral compass aligns with mine. We actually offer our customers access to up to $1,000 based on the fact that they have direct deposit with us, regardless of their credit score. After they've been a customer, I want to say it's just 3 months after being a customer for 3 months. And this is what we just call, and it's the money access to $1,000. It's up to $1,000, 0% for 3 months. We don't, and you just have to pay it off in 3 months. So if you weren't expecting a certain bill or something at Huntington, our customers have $1,000 up to $1,000 loan for 0% for 3 months. And so, think of, getting a flat tire on the side of the road, and that's just, you could afford a couple $100 over 3 months, but $1,000, right? It can make a huge difference for folks. So we'll pause here for questions, but just some things for you guys to consider as far as making that map of where to start. What do you want to do? What do you feel like is the best path? How will you go about it? I encourage you to share your plans with someone. It always helps to know someone is sort of there, right, holding you accountable to whatever you decide. If you have a banker that you know, I encourage you to reach out and ask them about how their products or services might be able to be beneficial to you. And then, of course, Chuck and I will continue to be here as resources. We would love an opportunity to help you. That's why we're here today. And then, just asking yourself, who do I trust to discuss my concerns and financial goals with? Our next modules that we're doing is around income and expenses. And then we're going to be doing credit reports and identity theft. So this is really the kickoff for managing debt. And then, this is a great time if you guys have questions. I think we took up the whole time, but any questions that you guys have, feel free to come off mute, put your stuff in the chat.